Hello, I'm Ernie Humphrey, the CEO of Treasury Webinars. I would like to thank everyone for taking the time to join us for our webinar today, Payments Optimization, the Art of Leveraging a Comprehensive Payments Program. I would like to thank our webinar partner today, Comdata, whose strong commitment to thought leadership helps us make this webinar possible today. Modern finance and treasury leaders have been left with a delicate balancing act between managing their traditional operating functions and being a hub for uncovering strategic business opportunities. An often overlooked source for the latter, your payments program. Advances in technology, along with an increased focus on strategic partnership from payment solution providers, means now is an ideal time to evaluate how effectively you are managing payments across your AP, purchasing, travel, and payroll programs. Many treasury and accounting leaders are unaware of new low-cost technology to dramatically improve these functions. Today, we will discuss how to evaluate technology and services that help companies generate rebate revenue on invoice payments, increase security and control, minimize the pain, hassle, and experience of paper checks, and diversify treasury relationships and establish new treasury credit sources. Before I delve into the content, I'm going to offer a few quick words about Treasury Webinars, cover a few housekeeping items, and then I'm going to welcome our featured speakers, Jack Sevier and Josh Raymond, to the webinar. Treasury Webinars offers webinars designed to empower Treasury, accounts payable, and accounts receivable success at companies of all sizes across all industries. We only do what we do best, which is webinars. Now for the exciting housekeeping items. For those of you interested in CTP credit, you'll have to answer all of our polling questions during the webinar and remain on for the duration of the webinar. If you have any questions regarding CTP credit, please send an email to ernie@treasurywebinars.com. Note that I've put my email address into the chat area of your GoToWebinar control panel. We'd love to hear from you today, so we can take your questions at any time during the webinar in the questions area of your GoToWebinar control panel. We'll do our best to get to your questions during the Q&A session at the tail end of the webinar. Fear not, if we do not get to your questions, we will follow up with you directly after the webinar. Finally, we appreciate your consideration in taking a short survey at the end of the webinar, as we always strive to improve the ROI we offer our event attendees for their valuable time. It is now my distinct pleasure to welcome Jack Sevier and Josh Raymond to the webinar. Josh Raymond is the Vice President of Marketing at Comdata, where he's responsible for marketing strategy, lead generation, product marketing, and sales development. Previously, he was product line manager for Comdata's commercial credit card solutions. Josh has more than 15 years of experience in corporate strategy and growth-related roles in financial services, transportation, and manufacturing. He earned an MBA from Johns Hopkins University and a bachelor's degree from the University of Tennessee. Our other featured speaker today is Jack Sevier. He's Director of Product Management at Comdata. He's responsible for product strategy and development for the company's corporate payments products and AR solutions. Prior to joining Comdata, he led corporate strategy and logistics, partnership pricing, and inventory for transportations and logistics organization. Jack holds a bachelor's degree from the University of Mississippi, a master's degree from Middle Tennessee State, and an MBA from Rutgers Business School. Jack, the floor is yours. Please take it away.
Okay. Thank you, Ernie, and thank you everyone for taking some time to out of your day to listen to us. What we're going to cover today is a few things. What do we mean by a comprehensive payments program? And this is really thinking about taking a holistic view of your AP. We're talking physical cards, virtual cards, and you think about both old and new concepts. Part of this is going to really focus on the tools and technology that's available today. So how do we get out of manual processes? Manual processes are slow, inefficient, and often they're riddled with errors. And so a big part of the tools and technology is really surrounding automation and automating processes. And then we're going to give you some simple checklists for evaluating your payments program. So first off, let's look at where most business-to-business payments are right now in the paper checks. As a matter of fact, about 55 to 60% of B2B transactions are still done with paper checks. Why is this a problem? Well, as we say here, paper checks are expensive, and there's a lot more expenses that go into paper checks than you typically would just think of right off the top of your head. Obviously, there's the check stock, the ink, the cost of printing the checks. A lot of that has been outsourced, but there's still the envelopes and the postage required for mailing. Often for some really critical payments, there might be overnight delivery fees, destruction of paid checks, stop payment fees, bank fees. But really one of the biggest costs that people don't think about is just the slow, inefficient manual processes that go along with this. Also, a really big problem that we see with paper checks is fraud. It's one of the most easily duplicated and processes out there for payments, and so really isn't the way that we want to do business moving forward. Certainly, as we think about automation and moving to some modern tools. So a modern payment strategy really relieves a lot of the pain points that you're thinking about today. And what we're really looking at with this graph is how do we find the right payment method for each expense that we're looking at, really when we're evaluating the entire P&L side of the business. For traditional cards, you've got simple purchases. Think about your T&E. Think about your office supplies, things that you have to run out and just get on a moment's notice. Typically small transactions, and it's not something that you do a lot of analysis behind. It's not really that strategic, type of purchases that you're making. Ghost cards. This is a term that might be, not very familiar to people. A ghost card operates exactly like a traditional credit card that you think of, where you typically have a line of credit that is, deducted from every payment that's made on the card. And then at the end of the month, you'll settle back with your issuer. This is, really, we find a lot of value in this for utility companies, somebody who wants to keep a card on file, and so it's not, a payment method that changes every month. So again, these are typically a little bit larger transactions, but not something that is really strategic in nature. On the high end, we've got ACH. Now, this is going to be your low volume, very large purchases when you think about major CapEx expenditures, things of that nature. Typically, very large transaction sizes. The reason for that is the fees on this are typically lower for your suppliers. But one of the big drawbacks is that the reconciliation and the actual payment have to travel down separate paths. And so that's why it's not really a good option when you're thinking about payments that you're making on a regular, ongoing basis. And so really the sweet spot are virtual cards for your AP. These are going to be for the vast majority of your transactions when you're thinking about kind of a modern business that's really trying to leverage their AP group.
Jack, can you take us through the difference again between ghost cards and virtual cards? I think those terms might not be familiar, and I'm already getting a few questions. So before we go on, can you give us a little more color on those, please? Thank you.
Of course, and I should have said your virtual card is going to devote some more time to this later in the presentation, but at a high level, they look very similar on the face of it. A ghost card operates like a traditional credit card, so it'll have the 16 digits, expiration date. It'll have the 3-digit security code on the back, and it's typically you've got the line of credit. You put charges to the card, and then you pay that off. A virtual card, like I said, on the face of it, looks like a traditional credit card or a ghost card, right? Because there is no physical plastic behind either of those. Virtual card has 16 digits like a traditional credit card. It rides on the traditional MasterCard or Visa rails. So the payment process is the same. It's got the expiration date, the 3-digit code. The difference about the virtual card is that a virtual card is a one-time use payment method. It's really, when you think about it as a check replacement as opposed to a credit card replacement. If you're paying 3 invoices at $100 a piece, when you make your payment run, your virtual card issuer will generate the card, and that card will be authorized for $300. and when it's delivered to the supplier, it'll say, this card is for $300 and it is meant to pay invoices 1, 2, 3 at $100 a piece. Your supplier is able to run that card, and then it's really worry-free on your side, because should their systems get hacked and that virtual card number makes it out into the black market, there's no exposure on your side, because all the funds that are on that card have been used up. So it's a really secure way to make payments.
All right, perfect. Thank you.
Yep. Okay. So as we mentioned, we're going to look at the entire payments program that a typical organization has here. I'm going to start off on the AP automation side, and then, as Ernie mentioned earlier, Josh will take over for some of our other products. But this is, like I mentioned, everything, when you think about the expense side of your P&L. So from the AP automation side, we've got integrated payables. What does that mean? And then some of the pieces that roll up underneath that would be a buyer-initiated payment. And one of the things you'll learn about, the fintech world is that we come up with multiple names for everything. So a buyer-initiated payment, also known as a push payment or an STP payment. Virtual card, also known as e-payables. But we're also going to go into some of the more traditional, so the corporate card programs. Everyone's familiar with the corporate multi-card, and it certainly has its place, but purchasing cards and fuel cards can also deliver some value to you. Travel and expense management, some of the different tools that you need to look at out there, and some of the new things, such as a virtual card for travel. And then workforce payment solutions. This is kind of a newer side of the business. Often they appeal to some of the younger workers, or they have a lot of use in specific industries, and Josh will really hit on those kind of later. So diving into the first one here, AP automation. Like I mentioned, integrated payables platform. I'm going to talk not only about what is it, but what isn't it. There's multiple versions out there. So when you're in the market kind of evaluating the different offerings, I want to arm you with some knowledge so you can kind of see the differences. I already talked, kind of high level about the buyer-initiated payments. We're not going to really push in on those too much, but virtual card, this really goes hand in hand with the integrated payables. And so this is one of the things. You can have virtual card without integrated payables, but you really can't have integrated payables without the virtual card. So we'll talk about how those come together. And I believe this brings us to our first polling question.
Yes, sir. Thank you very much. Our first polling question is asking you to share with us if you currently use an integrated payable solution. This will be incredibly valuable to our speakers as we go forward and talk about the integrated payables solution part of our presentation today. I appreciate everyone's consideration in answering all of our polling questions here today. Just a reminder, those of you who are interested in receiving CTP credits for today's webinar, you'll have to answer all of our polling questions. Also want to remind you that we can take your questions in the questions area of your GoToWebinar control panel. I encourage everyone to take advantage of the opportunity to tap into the expertise of leading industry experts that we have. So we're very fortunate to have them on the webinar today. So I'm going to go ahead and close the webinar. We wouldn't want to do that. Close the polling question. Then we'll go ahead and take a quick look at the results, and then we'll get back to our content and dive in on integrated payables. Let me go ahead and close that polling question. Let's take a quick look at the results here. And Jack, have any initial thoughts here?
I will say that option B there, the familiar with integrated payables, is actually higher than I've seen when we've done this in the past. Which is, really promising that we're starting to get out there into the market and really educate people as to what the options are out there. So that's a really positive thing to see.
Okay, thank you very much. I had the same thought as well. So let's go ahead and dive into integrated payables.
Yeah, so integrated payables, and as I mentioned, we put about 12 names on everything that we come up with in the industry. So you'll hear integrated automated AP, single file disbursement is one that gets thrown around there, paperless AP, payment hub, a lot of different names for the same concept. Integrated payables is really both software and services from a payments provider that allows you to easily kind of track and make invoice payments. You want to eliminate all the manual and duplicative processes for whoever is paying the bills in your organization. And so when you think about a traditional accounting system, you have to do multiple payment runs. So you batch your payments by type, your ACHs, your wires, your virtual cards, your checks, and then you process each one of those payment runs separately. What we're talking about with an integrated payables platform is that you get to do one payment run from your system, and then the integrated payables platform, that's the piece that has the learning behind it that recognizes who the payments are going to and who's going to be willing to accept the card payments, who's getting paid by ACH. And so it eliminates a lot of that manual work that you're doing on your end of trying to identify which vendors are getting which payment type. There's two models to this, really. There's the first model where the provider is going to be the one who's taking possession of the funds. And so you make your payment run, that goes off to your provider, and they're the one who is going to be taking money from you, and then they're going to be dispersing the payments out as they see fit. The one that we're really going to be talking about today is where the provider links to and pays out of your own accounts. So when you have a check ACH wire, this is a model where those funds remain in your account, and then your provider links into your account and makes the payment on your behalf. And so it really gives you the power in the relationship. You maintain the visibility into the transaction. So again, that's what we're going to be talking about today. But as I mentioned, integrated payables, the main part of that is really the virtual credit card. So as I mentioned earlier when I was giving the high level, this is a check replacement tool. This is not a credit card replacement tool. So virtual credit card, V-cards, e-payables, they are payments that are tied to a specific payment. So again, you get the invoice from your vendor. You say, I'm going to be paying invoices 1, 2, and 4, but not 3. When that virtual card is cut, that payment is designated only for those invoices, only for those payments that you're wanting to make. And it's tied to a specific dollar amount, so it can't be overcharged from the side of the supplier. It's safe, secure, and timely supplier funding. This is because as soon as you decide to make the payment, unlike a check where you have to put it in the mail and wait for the postal service to do their thing, or even if you're trying to overnight it, we're going to be faster than that, because as soon as you decide to make that payment, your payment file is going to go to your issuer. Your issuer is going to generate the card and immediately email it out. Some issuers, instead of emailing the card number, what they'll do is they'll email a web link to the supplier, and then the supplier logs into that issuer's portal to get the card details. But again, it's instantaneous and it's traveling electronically, so it is much quicker than that. It will be coupled with the electronic remittance advice, allowing them to easily reconcile the invoices that you're paying on their side. And something on this that's a big deal to the suppliers is most of the virtual card issuers will include an industry standard file format, allowing them to just ingest that file directly into their AR system and close out the open invoices. This is really handy when, instead of paying 1, 2, 3 invoices at a time, if you're paying 10, 20, 30 invoices at a time, which we see quite often, that really makes it a lot easier on your supplier side to go through and close those out. Again, this is a one-time use card, so you don't have to worry about, after it's been processed, you don't have to worry about that card number getting out into the the dark net or anything like that. It integrates into your normal AP workflow. It's just another payment type. So again, take a step back before, when we were talking about in the world before integrated payables, where you do your different batch runs. This is just another one of those payment types if you're not going to go for the full integrated payables. You do your check run, then you can do your virtual card run. Again, the things I can't head on enough, right? There's no piece of plastic that goes behind this. It is different than the Ghost card because this is a one-time use versus the Ghost card, which is really a traditional credit card, just without the piece of plastic behind it. And so why do we want to go to virtual cards? It's the reduction of those. Oh, sorry, just that one slide, Ernie. It's the reduction of the paper checks, and one of the stats that we'll show you later is that paper checks are, and this is from the industry minds that analyze this kind of stuff. So not just from us and in the virtual card industry, but paper checks are about $5.14 for every check that you're going to be cutting. So there's a real cost of that, and we want to eliminate that cost. And these reasons are why you see the virtual accounts growing 30% year over year. Now we can move on to the integrated payables diagram, and there is a lot going on this slide, and I certainly don't expect anybody to want me to even go through everything. So I'll just kind of hit the high points here. Integrated payables is how we process payments with a single file. So virtually every system that I've seen has been able to produce a standard check file, and that's just what you do in the integrated payables world. You produce that check file, and that goes into your integrated payables platform. And that's where the database of all the different payees is able to sit there and look at that check file, and that's where the decision is made as to who's going to be getting a card, who's going to be getting an ACH or a wire, who still needs a paper check. So the provider is able to help you set up the different payment methods. One of the things you need to kind of look at when you're shopping for a provider is what is their enrolled vendor database. Because one of the big deals about trying to get people onto the virtual cards is much like you get a lot of personal credit cards have a cash back component to it. Your virtual card program is going to have a rebate tied to that, and so you want to get as many of the vendors as you can onto the virtual cards. This is also where you're able to input your rules into the system, and so that database is going to be able to sit there and, okay, we understand that this supplier can't accept payments above $10,000, and so it'll be able to recognize. You want a system that's going to be able to recognize those specific rules and do the payments accordingly. You're able to keep your standard transaction flow. So if a big payment requires some sort of controller approval, something like that, all of that is able to be uploaded into the system, so you can keep your standard transaction approvals in place. So from there, like I mentioned earlier, there's two models to this. The one we're talking about is where the system integrates into your treasury. So ACHs and wires, there will be a link into your treasury bank, and those payments will be processed accordingly. Often you want to look for a provider who has a separate check facility. Even if you have all of the materials and tools to print checks at your own place of business, often you're going to be able to drive efficiencies by going to a facility that really specializes in the check printing. And then again, as I talked about, the virtual card platform. So all of these, payment methods will then be delivered to your vendor. As the payments are processed by your vendor, that will be recognized in your payments platform, into your integrated payables platform, and so you'll be able to get the file that you need to recognize what invoices have been paid, You'll also have the information at your fingertips. So if you had a supplier who, for whatever reason, didn't run a credit card, and so now you've got a virtual card for some invoices that's been sitting out there, you and your virtual card supplier are able to, approach that vendor and, just remind them that there's a card on file for these invoices that you're trying to pay, so they should go ahead and process it. So what are the benefits to using the integrated payable solution? Certainly once coupled with the virtual card. As I mentioned earlier, you're able to execute all of your payments at one time. No need for the separate payment files and separate payment runs for each type. You're able to manage all of them through your existing ERP, so there's no additional training that you have to do for your people. Everybody still has visibility, especially once you have, if you're in an organization where you have multiple business units, multiple locations. Right now, you're able to kind of boil everything into one source of truth with those seamless approval workflows and all the comprehensive reporting that goes with that. Minimize the time spent managing the payments. Again, no more batch processing, cash requirement approvals. Everything is, to your ERP now looks like a single payment mode. And then you let the engine for the integrated payables platform do all the heavy lifting. You're able to further reduce your AP costs. Again, this is giving you the visibility into the different payment methods that are going out there. As I mentioned, the checks are expensive, and you can see we've got there's the stat I was talking about earlier from PayStream Advisors, the $5.14 a check. Giving you visibility into the number of checks that you're sending out today. Wires are very expensive, so giving you visibility into all that, you can really see where you're kind of leaving money on the table. And then the greater insight, that really goes hand in hand with what I was talking about there. That's why 70% of CFOs are really looking into actively seeking to increase the use of the virtual cards and the integrated payables platforms, because it's more than just the cash in the door from your rebates. It's the hard elimination of costs, lowering your exposure to things like fraud. So, and then here's the checklist that we've kind of come up with for doing an AP automation evaluation. Evaluate your check processing costs. And again, you have more than just the hard costs of the paper stock or the check stock and the ink. What about fraud? What about errors? And then what about the labor that goes in? One of the things that we still see with the paper check processes is that you'll have an AP manager who will have a 1-inch stack of checks, and he or she has to manually go through and sign those checks before they can be stuffed into an envelope and mailed. That you didn't hire these people for them to sit there and stuff envelopes. So really kind of evaluate, boil down the cost, and what does it take for you to send out a paper check? Organize an internal discussion with the leadership. Find the growth that an automated AP system can really help you achieve. Because if this isn't an area that you're looking to drive efficiencies, one of the things your competitors are. Hence the tremendous growth in this side of the industry. Revisit the payment terms with some of your suppliers. Is there a way for you to reduce the float that you've got out there on your paper checks? It certainly benefits you. And obviously for your suppliers, one of the things that they are really interested is having the cash come through the door more quickly. If you want to speed the payment to the vendors, there's really nothing better than a system that automatically emails them a payment as soon as you go. And then calculate the potential rebates. And a back of the envelope way of doing this that you can think about. Take 3% of your organization's annual revenue. Figure your rebate is going to be probably somewhere in the 1 to 2% if you're a traditional organization. And that's kind of what you can expect. That's generally what we see for the average organization. Add in cost savings, right? Look at those check costs that we were talking about earlier. $5.14 if you don't have the numbers on your own end. So, typically you can eliminate, very quickly off the bat about 50% of the paper checks that you're cutting today. So now you've got that cash rebate coming in the door to you, plus you've got the cost savings, 50% of your checks eliminated. But I can tell you some of the best in class customers that we see are often able to drive that rebate, much further than 1% to 2%. So with that said, I'm going to turn it over to Josh, who's going to start off talking about some of our corporate card programs.
Thanks, Jack. So as we kind of transition into a different section of our webinar here, I think we're fully ready to admit that corporate credit cards are not really new technology. Companies have been using credit cards for purchasing, travel, fuel for decades now. But as Jack mentioned in his introduction, cards still play an important role of any comprehensive payment strategy. And so we wanted to spend a little time covering those today. Ernie, I'll turn it over to you. I think we've got another poll question here.
Yes, sir. Thank you very much. Kind of level set the audience a little bit here before we dive into corporate card discussion. So we're just asking you to share with us if you currently use a corporate card program. Again, I appreciate everyone's consideration in answering all of our polling questions here today. Again, those of you interested in CTP credits need you to answer all the polling questions today. Just want to remind you as well that we can still take your questions in the questions area of a GoToWebinar control panel. And once again, once I close the polling question, we'll go ahead and take a quick peek at the results, and then we'll go ahead and get Josh's initial take to see whether those line up with his expectations, and then we'll dive a little bit into corporate card programs, and we'll look at a corporate card, how you evaluate your corporate card program. So let me go ahead and close that polling question here and give you a couple more seconds. All right, then let's go ahead and take a quick peek. And we have, Josh, do you have any initial reaction here?
This is kind of the split that we would expect to see. Again, corporate cards have been around for a couple decades now, so they're fairly widely used. But like we see, 32% of our attendees here don't have a corporate card program. That's not uncommon either, and it kind of spans across all company sizes. My wife works for a major healthcare company, one that generates tens of billions of dollars every year. But when she travels, she puts it on our personal credit card, and she has to go through a manual reimbursement process. So even large enterprises still haven't fully bought into corporate cards. And so if you're in the no category there, that's quite all right. So as we think about evaluating your existing card programs, there are a couple things that we think you should consider. The first is how you're reporting purchases that are made with cards. Again, many companies still use a very manual expense reporting process, which is very time intensive and costly. You can see the figure on the right side of the screen here. Industry research says that it costs an average of nearly $20 to process a single expense report. And aside from the cost, just think about the pain that's involved with expense reporting. Those of you who travel, or those of you who are responsible for administering travel programs at your organizations, think about the time it takes to review and approve and reconcile these reports. You've got to track down lost receipts. Employees aren't great about submitting their expense reports on time. Somebody's got to review them for policy violations. We've got to fix mistakes that happen when they're coded inappropriately. So all these things really add up to kind of the pain, the hassle, and the cost of administering a corporate card program. The good news is that there are numerous software programs available to automate this process. And many corporate card issuers, whether it's a bank or American Express or a company like Comdata, we offer free tools to use for this expense reporting process when you have one of our card programs in place. The second tip here is to consider consolidating all of your card programs to one provider. We really recommend this strategy because it offers a few key benefits. First, it allows you to leverage the combined spend volume to increase your rebate rates. So if today you've got separate card programs with maybe a bank for purchasing cards, you could be with American Express for travel, and then maybe you're with a specialty fuel card provider, you're not really maximizing your ability to earn rebates because to each one of those providers, you're a fairly small customer. But if you consolidate all those programs with a single provider, now you've become a big customer and you've got more negotiating leverage to get a better rebate rate. The second reason that we like this strategy is that it makes life easier for you because you've only got one provider to manage. So there's, maybe one relationship manager, there's one set of reports to look at, there's one invoice or, one set of invoices each month. So it really makes life easier from an administrative standpoint. And then lastly, it makes reporting and reconciling much easier on you and your staff. Again, it's one provider to deal with, one place to go to get reports, one statement, and so life just gets a lot easier. The third and fourth points on the slide really go hand in hand. So evaluating your card profiles and spending limits is a good exercise. This really boils down to security and control. You want to make sure every employee who has a card is restricted and able to buy only what they need to purchase. So make sure that those people who only need to buy fuel for a vehicle are set up to where their card will only work at fuel merchants. Conversely, you may have a senior executive who needs to just be able to buy whatever they think they need to buy, and so their card might be opened up to any kind of transaction, and they might have a really high spending limit. And then you've probably got people who are in the middle, folks who travel and need to be able to pay for meals and hotels and transportation, but they don't need to be able to go to Best Buy or, go to Amazon.com and use that card. So once you have these controls in place, consider increasing the limit for purchasing card transactions. This helps you capture more spend on those cards and earn more rebates. For those of you who use a purchase order process, it eliminates the need for some of those POs on smaller transactions. And as we've talked about a lot, it helps you eliminate more check payments. The more you can make purchases electronically with a card and not with a check, the better that is for your business. So if you have the right profiles in place and those cards are kind of locked down to the right categories, then you can increase spending limits without much risk because you've got visibility into the transactions that are made, that the ability to go rogue, if you will, is really limited. And so increasing spending limits becomes less risky. So if we move on, the next category that we wanted to cover is travel expense management. And this is kind of a natural extension of the card programs that we just discussed. A lot of clients that we work with think that if they have a T&E card in place, that's all they really need for a travel payments program. But there are some new technologies and approaches emerging that we wanted to cover in the webinar with you today. So when we help clients evaluate their travel expense management program, we think about the end-to-end process from when an employee first decides that they need to travel for business, all the way through to the expenses being reported and closed out and any out-of-pocket expenses or costs being reimbursed. And if you're involved in this process for your organization, you know that it's pretty complex. You've probably got multiple systems that have to be used. There's a reservation and a booking system. There's expense reporting processes, whether that's spreadsheets and paper, or maybe you have a software tool in place. Certainly there's your ERP or your accounting system, your payroll system. All these things kind of get involved with managing travel expenses. So think about, the process from end to end. And now obviously a good T&E card program is critical. There are lots of good providers out there that have solved for the need for a plastic card to help business travelers. But the big thing that we want to highlight is an emerging strategy to use virtual cards for travel purchases. Jack talked earlier about using virtual cards to make invoice payments in an AP shop. But just in the last, I would say, 36 to 48 months, we've seen virtual cards for travel becoming much more popular in the US. Virtual cards for travel have been pretty standard in Europe for a while now, but they've made their way across the pond, and we see a lot of US-based companies starting to implement virtual cards for travel. Ernie, I think we've got another poll question up.
Yes, sir. I'm going to go ahead and launch that next polling question, asking you to share with us if you currently use virtual cards for travel. As always, we appreciate everyone's consideration in answering all of our polling questions. And the great news is we are getting a lot of questions in the questions area of the GoToWebinar control panel. So keep those coming. And have no fear, if we do not get to your questions during the Q&A session, we will have someone follow up with you directly to address your questions. So thank you for all your questions. Love your questions. Keep them coming. So in order to be mindful of our time, I'm going to go ahead and close the polling question, and we'll take a quick peek at the results, get Josh's initial reaction here, and then we'll dive a little deeper into how virtual cards for travel work. So let me go ahead and close that polling question. Let's take a quick look at the results. Josh, any quick thoughts here?
This is not surprising. Like I said, we haven't seen a ton of adoption of virtual cards for travel in the US yet, but I think what stands out here is similar to the polling question around integrated payables. I think the level of familiarity, or at least the awareness of virtual cards for travel, seems to be trending upwards. So that's a good sign. Okay, so we saw in that poll that there still are a lot of people who aren't familiar with virtual cards for travel, and as you would suspect, the basics are very similar to a virtual card that's used in an accounts payable setting. It's still a 16-digit card number, which provides a lot of security and control. You typically earn a rebate on spending, just like you would in an AP setting, which is obviously very valuable to an organization. But for travel, virtual card providers have figured out how to integrate with your travel booking systems to make airline purchases, hotel reservations, rental car purchases with a single-use card. So with this technology, your accounting staff can actually tie transactions back to specific employees and specific trips in a much easier fashion, because it's an independent transaction on a one-time use card. It's not just one of hundreds of line items on a monthly statement. So if you use a ghost card or a card on file with your travel provider today, everyone's travel gets, bucketed into the same transaction or in the same state. And so it gets really hard to figure out which transaction is tied to which person and why they made that purchase. So by paying for the big ticket items, air, hotel, car rentals, by doing that centrally with virtual cards, you guys can also reduce the credit limit on your individual T&E cards, because now employees only need to pay for meals and incidentals on that plastic card in their pocket, which allows you to really tighten up on security. you can see that 15% of all employee fraud is done on expense reimbursements, and it rarely gets caught. By using virtual cards for travel and reducing employee spending, or reducing their limits, you can really increase your protection against employee misuse. So if we move on, we've got a diagram here that kind of explains how a virtual card works in a travel management setting. And this flow chart does a pretty good job of explaining it. If we start on the top where you see the green customer box, that's your employee, that's the traveler. That employee books their trip just as they would today using your existing booking system. But because that system is integrated with your virtual card provider, the booking data for that trip is pushed to your card issuer and a virtual credit card number is generated. Again, that's a 16-digit one-time use credit card. That card number is then pushed back into the booking system and used to make the purchase with whatever supplier it is, whether it's American Airlines or Southwest or Hilton Hotels. That single-use card is used to make that purchase. And then the airline or the hotel or the car company processes that transaction just like they would any other credit card. Your credit card provider then sees that the transaction is processed and delivers a notification back to you for reconciliation and reporting. Now, this probably looks more complicated on paper than it really is. In reality, not much changes from the perspective of you or your travelers. Life just gets a lot easier because of some of the benefits that we had talked about earlier. Okay, so if we move on, some other tips that we suggest as you evaluate the travel component of your payments program. And one is review your travel policy. It's important to audit your travel policy on an annual basis to ensure that the proper spending limits are in place. We suggest that you review and adjust your travel policy really as an opportunity to increase visibility within your organization. We tell clients that they should review who within the organization actually has a travel card. This helps ensure that everyone who needs a card has one, but also that cards that are no longer needed are deactivated. Again, thinking about fraud and risk, if you've got an employee who still has that corporate card in their pocket but doesn't need it, that's just unnecessary risk exposure. And lastly, just like we were talking about in the previous section, take a fresh look at the profiles and spending limits you have in place for your travel card holders. Okay, so we are in the home stretch here. The last section that we want to cover is the part of your P&L that we would call workforce payments. The term workforce payments typically makes people think about payroll, and that's certainly the biggest spending category in this section. But there are many types of other payments that companies don't often think about, and they're really important to consider. So as we move on to the next slide here, we've got some of those things listed. You can see there's lots of different categories here, and checks rear their ugly heads in many scenarios, and we would ask you to consider these as you evaluate your payments programs. These are expense categories that most companies have on a regular basis, but very few have figured out an efficient way to deal with them. So termination pay, for example, that can be really difficult, especially if you're a company with employees in California where you're required to pay an employee all the wages due to them on the day that they're terminated. So getting that payment to them in real time is often complex and difficult. Getting funds to employees for things like special projects, for events, travel, per diems, or other kinds of reimbursements is often pretty tricky. These types of payments can all be made electronically with a prepaid card. I won't go into a lot of the details on the differences between prepaid cards and credit cards. The main takeaway here is just that this solution exists and it's something that's worth looking into, again, thinking about check elimination. Okay, so if you haven't heard us yet, I will say it for the last time. Paper checks are expensive, and they are bad for your financial operation. Jack mentioned earlier that the estimated cost for a check in an AP setting, when you factor in all the costs, is about $5.14 per check. In a payroll setting, if you kind of factor in all of the wage payments that are made to the average employee during the year, that cost is about $229 per year simply to pay an employee with a check. Now, the other thing to consider here is how much it costs your employees to be paid by check. There's data out there that shows that banking fees and check cashing fees rob your employees of a big chunk of their wages. Using a card for payroll and moving to electronic payroll obviously lowers these fees and adds a lot of convenience for your employees. So we see many companies that come to us and they want to consider a payroll card because of the cost reduction, but they also think about it as an employee benefit or part of their total rewards program. I think it's important to point out that employees of all kinds and all income levels really see a lot of value in payroll cards. People who are on direct deposit already still like to use these cards for budgeting and managing their spending. So even if you have an all white collar workforce, we still highly recommend putting a payroll card program in place. So that's it. We can kind of recap here and then move on to the questions. So I'll just kind of summarize by saying that, across the expense side of your P&L, a lot of costs and inefficiency exists when it comes to making payments. Much of those problems are caused by paper checks, as we've reiterated several times. There are tools and payments products on the market to solve for all of these scenarios. And right now, we're in the middle of the year. This is a good time to really evaluate your payments programs before we get into end of fiscal year and all of the complexity and work that comes with closing out the books for the year. This is a good time to evaluate your payments program and start looking for solutions before we get to the end of the year. So thanks very much for joining us. I think we've got a few minutes to tackle some of those questions.
Great. Thank you very much, Josh and Jack, also for your fantastic content. So I was just at an accounts payable conference myself speaking, and there's a lot of conversation going on, which is great to see, which you both mentioned for the polling question. So I think we're doing a good job on the thought leadership front, and companies are starting to consider each of these programs. But I think it's clear from the webinar that it makes sense to consider these all at once in a comprehensive payments program. So Josh, let me go ahead and direct the first question your way. Just a little bit more about the mechanics for a virtual card payment. So does your supplier need to accept credit cards in the first place, and then are they making that transaction manually? So how does the back end of that really work on a supplier side?
So the short answer is yes. I mean, obviously the supplier needs to be set up to accept credit card payments. And the way that they process that on their end varies. That's kind of a business decision that they make.
Okay.
Some companies will kind of process those. They have a point of sale terminal in the office, and they'll process those cards manually. Other vendors have more of an automated solution in place that allows them to process those incoming payments in a much more streamlined fashion. But maybe the kind of underlying question that this person was getting at was, how do I know as a buyer, how do I know which of my vendors will take a credit card? And the answer is that you should really look for a virtual card provider that has a really good vendor enrollment strategy or vendor enrollment service in place. Some providers might call it supplier enablement, but most virtual card providers will offer some sort of service to help you reach out to all of your vendors and enroll them in your virtual card payments program. And that's a really critical component of a good program, because obviously if you don't have a way to actually get your suppliers to accept that form of payment, the program has very, very little benefit.
Oh, fantastic. Let me just go ahead and piggyback off that a little bit. So I think one of the things underlying, overarching that we're saying is it makes sense to look at optimizing your payments portfolio. And so one of the first steps is checks. Let's look at eliminating those checks. And then let's next start to look at which of our suppliers would be good candidates for these virtual cards and the rebate programs. And so we start to optimize our portfolio of payments. So I think we're seeing a lot more conversations about that, and having the comprehensive payments program absolutely facilitates that process. So we need to be looking at what's our payments portfolio, what are our targets, what are our strategies, and who's the best partner to help us reach those goals. Jack, can you run us back through the calculation, the back of the envelope calculation on the potential rebate amounts? I have a few questions about that calculation, how you did that 3% of sales, and then can you take me from there?
Yeah, no problem. I think as you're, and the question is, really surrounding if I want to, figure out what my potential rebate would be, how can I go about that, starting from ground zero. In kind of the back of the envelope, what we see for a typical virtual card program is, take 3% of your revenue, and multiply that by 1 to 2%, which is your typical rebate rate that you see out there in the market. On top of that, if you want to look at a more comprehensive view of what this program would be worth to me, look at the number of paper checks that you're cutting today. Typically, we can eliminate paper checks by about 50%. So take that $5.14 metric. And half of the checks that you're cutting today, and so that's a cost elimination. So you take your rebate, put it together with your cost elimination, and that'll give you a holistic view of what you can expect from a virtual card program.
All right.
Yeah, Ernie,
go ahead.
I would just add that 3% is really just kind of a benchmark to assess the spend volume that you would typically be able to put on your virtual card program. So that's the benchmark that we see if a company looks at the spend volume in their total accounts payable, and then how much of that can typically be enrolled in a virtual card program. That number tends to be around 3 to 4% of the company's top line revenue.
Okay, fantastic. We got time for one more question, and I'm going to launch our final polling question, and I'll push this question to you, Josh. Can you just highlight some of the recent functionalities that have been launched this year, and then things that we might look for the rest of the year in 2019? Give us a little preview.
Specifically with virtual cards, or
whatever,
in general?
In general, with Comdata and what you're seeing out there, what are some of the enhancements that we have seen and will see that are going to help make these products even more valuable?
Yeah, I think what we're starting to see in the market is that all of the payments providers are trying to figure out how to integrate different programs and tools in a more seamless way. Because if you think about the difference between managing your finances in your personal life versus how you do it at work, it's much different. When was the last time you wrote a paper check in your personal life? We've got online bill pay. We've got remote check deposit. There's all these different tools to help you move money and track your expenses and tie different accounts together. And you probably do that all in one place. Yet in a business setting, that is not the case. We see a lot of fintech providers and banks trying to solve for one piece of the puzzle, but nobody's really figuring out how to make all these different systems and tools talk to each other so that our audience here today, the folks that are managing financial operations for businesses, get the benefit and the ease of use and the simplicity that they want. So I think as we kind of look at the market and the big players in the market and mergers and acquisitions, a lot of it's around consolidating and trying to make this end-to-end process much more seamless.
All right, thank you very much. With that, I'm going to officially close the Q&A session. Again, we'll follow up with those of you whose questions we did not get to. I would like to once again thank our featured speakers, Jack Severe and Josh Raymond, for their great content and insights. Also like to thank our sponsor, Comdata. We share and appreciate their commitment to thought leadership. Please note you'll have the opportunity to request being connected with Jack or Josh via our post-webinar survey that will launch immediately following the survey. And finally, to you, our audience, thank you so much for your valuable time. Make the rest of your day great, everyone.